Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's story with you. We're living in a time of rapid technological advancements, and one of the most significant trends shaping the business landscape is the integration of artificial intelligence into various industries. However, as we've seen recently, this trend can also lead to increased volatility in the stock market. Case in point, Salesforce, the cloud-based software company that has been at the forefront of AI innovation. Despite reporting strong quarterly results, the company's shares took a hit after it issued a sales forecast that fell short of Wall Street's expectations. This has raised concerns about demand for its flagship AI agent platform and sparked a debate about the potential risks and rewards of investing in AI-focused companies. On one hand, Salesforce's investment in AI has enabled it to stay ahead of the curve and provide innovative solutions to its customers. On the other hand, the company's slowing revenue growth and the uptake of its AI Agentforce platform have raised concerns among investors. As we analyze the situation, it's essential to consider multiple perspectives. Some experts argue that Salesforce's struggles are a sign of a broader trend in the tech industry, where companies are struggling to adapt to changing market conditions. Others believe that the company's issues are specific to its business model and that it needs to revamp its strategy to regain momentum. From a technical analysis perspective, Salesforce's stock has been under pressure, with key support levels to watch around $225 and $200. If the stock breaks below these levels, it could lead to further selling. On the other hand, if the company can regain traction and push above $267, it could signal a recovery. As we navigate this complex landscape, it's crucial to remain objective and consider all the factors at play. We'll continue to monitor the situation and provide you with timely updates and insights to help you make informed investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show today and we're going to dive into a fascinating story about gold prices. If you're an investor or just someone who keeps an eye on market trends, this one's for you. So, gold prices have been surging lately, driven by global uncertainties, central bank demand, and expectations of Federal Reserve rate cuts. In fact, gold futures have rallied sharply, increasing by nearly Rs 6,500 in the last month, to hit a record high of Rs 1,787 per 10 grams on the multi-commodity exchange. Now, some analysts believe that this surge is due to the ongoing trade tensions and geopolitical uncertainties, which are fueling safe haven demand for gold. Others point to the sustained central bank buying as a key factor supporting the price of gold. And with the Federal Reserve expected to cut interest rates at its upcoming meeting, lower interest rates tend to make non-yielding assets like gold more attractive. But here's the thing, some experts are cautioning that it might be time to book profits, given the recent record highs. They're advising investors to keep a close eye on technical levels and be prepared for potential volatility in the market. As always, we want to provide you with a balanced view of the situation. While gold has traditionally been seen as a safe haven asset, it's essential to remember that markets can be unpredictable and prices can fluctuate rapidly. So, what does this mean for investors? Well, if you're considering investing in gold or already have a stake in the market, it's crucial to stay informed and keep an eye on those technical levels. It's also important to diversify your portfolio and not put all your eggs in one basket, as they say. We'll continue to monitor the situation and bring you updates as more information becomes available. In the meantime, we want to hear from you. What do you think about the current state of gold prices? Are you bullish or bearish on the market? Share your thoughts with us on social media using the hashtag #Riskwiserzone. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's episode with a closer look at the retail sector, where American Eagle Outfitters has been making headlines with its recent financial results. The company's share price surged an impressive 38% after reporting stronger than expected second quarter earnings, driven in part by the success of its marketing campaign featuring actress Sydney Sweeney. Now, let's dive into the details. American Eagle's net revenue came in at $1.28 billion, down 1% year-over-year, but still beating analyst expectations. The company's gross margin expanded to 38.9%, while operating margin rose to 8%. Perhaps most notably, diluted earnings per share jumped 15% to $1.45, more than double the predicted amount. The Sydney Sweeney campaign has been a game-changer for American Eagle, with her signature jeans selling out within a week and some products disappearing from shelves within just one day. The company's president, Jennifer Foyle, highlighted the strong demand for Sweeney's curated online shop, Sid's Picks, on the earnings conference call. But it's not just Sweeney who's driving interest in American Eagle. The company also launched a campaign with Kansas City Chiefs football star Travis Kelce, which has been gaining traction, particularly after his recent engagement to pop sensation Taylor Swift. While these developments are certainly positive for American Eagle, it's essential to maintain a balanced perspective. As Bank of America analyst Christopher Nardone noted, margin pressure from tariffs could still limit earnings upside next year. So, investors should remain cautious and keep a close eye on the company's progress. In conclusion, American Eagle Outfitters' recent success is undoubtedly a promising sign for the retail sector, but it's crucial to approach this story with a critical eye, considering both the opportunities and challenges that lie ahead. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.